let me get into really how it is we generate private equity returns. We essentially break the business into four main areas: sourcing and screening, which is essentially our pipeline of deals; pre-transaction, which is due diligence; value creation, which is the ownership of our businesses; and exit. Sourcing and screening is done constantly in our business. It's probably the thing we end up doing most of our time outside of actually the value creation stage. And here, we pay a lot of attention to building a brand. And when we talk about brand, it's kind of odd to talk about brand in the context of private equity. Generally, that's reserved to different types of businesses, but we feel that the brand should stand for something. It should create a pipeline of deals coming in, and the brand for TorQuest is really about our ability to partner with the people that are running our businesses, or all the various stakeholders that are involved. That can be management teams, it can be founders or owners of businesses that remain involved in the business when we own them. It can be the banks, it can be any number of people. So we spend a lot of time on the brand, and then we go out and we build relationships. We try and meet as many executives as possible, as many agents or brokers as possible, as many individuals that own business as possible, to come up with opportunities to invest in. And just to give you a quick snapshot of how this goes, we track the numbers between 2012 and 2013, and we found that in that period we looked at 610 deals. We issued 57 expressions of interest, meaning we were interested in perhaps doing a transaction with you. Out of that 57, 25 turned into letters of intent, which are really offers that bring us into the due diligence phase, and we closed 11 transactions, which included platforms and add-on acquisitions. So you can see it's a pretty lousy hit rate, but that's what it takes to get the deals that we like to do. Pre-transaction stage, I like to call this the initial stage is the first date. Here we're kind of engaged, and this is really the diligence phase. So where we're sometimes a great first date, the engagement doesn't always go so terrifically because we really get into the weeds of business diligence. In this particular stage, we'll evaluate an industry, and this is something that we guard very close to the vest because we actually are a fiduciary to other people's money. So we take the rigor of our due diligence before we make an investment very, very seriously, and we do a lot. So we look at the industry, we look at the business's place in the industry, we look at the management teams, we get to know them. We generally farm out third-party diligence, which is accounting diligence, quality of earnings, legal diligence, HR diligence, environmental diligence, whatever might be specific to that particular industry, we do with rigor. And then we have to apply a capital structure to the business. We are users of leverage. Leverage does improve equity returns. Our capital structures tend to be about 50% debt, 50% equity to start off with. They may go up from there once we have an understanding of the business, but generally right out of the gate, it's a 50-50 capital structure. And then we get into documentation. We do the purchase and sale agreement, we discuss representations and warranties with a vendor, and we close the deal. All along through this phase, we're developing what we call a 100-day plan, which looks at the first 100 days of our ownership and says, what do we want to accomplish? How are we going to measure the business? What is the strategic plan? How are we going to relate to the management team? How are they going to relate to us? So that the day after closing, there's no mystery as to what we're going to do. Our ownership phase is the value creation phase, and this phase is really where it all happens. The most important thing in this phase, actually two most important things. One is the development of a strategy for the business, which I hope we've done during diligence phase, and we're not waking up on the morning that we own the business and saying, what do we do now? So we have strategy that we're implementing in this phase, not developing. The next is really developing metrics around which we're going to use to evaluate and measure the business. What we do as opposed to what management does, is we're constantly measuring and monitoring the business. We need to do that rapidly, we need to do it accurately, and we need to agree with management up front as to how we're going to do that. You know, we can't run any businesses sitting in an office in Toronto. All the businesses are run out in the field. All the businesses are run by the management teams. The only thing we can do is measure, monitor, provide feedback, develop early warning signs if there's problems, early warning signs if there's opportunities, and then we can deliver opportunity to the business from the outside in. What do I mean by that? It means we can scour the market for add-on acquisitions, which is one way to build value. We can deliver relationships to the businesses. We create boards with outside people on them that are industry experts that can deliver advice to the management team of the businesses. And what we can do is always keep an eye on the exit. We can think about how we want to position the business to look so that we can get an outsized valuation or multiple on the business when we go to exit. So we're constantly positioning right from the get-go with an eye on the exit. Then when it comes time to exit, we generally develop milestones during our ownership of the business. And once we hit those milestones, we have a discussion with the management teams, with our partners, and we say, have we reached the milestones? Should we set new ones, or should we run a process and sell the business? And generally, it's the management teams that are leading us into the sale rather than the other way around. Almost exclusively, we hire an agent. We think that tension in a process delivers maximum price. So we hire an agent. The agent packages up the business. They generally shop it around to other private equity funds or strategic buyers, or in some cases, even an IPO.